this is Ken at Capital Advantage Tutoring. And you know, it's my job to get you through the exams. So I started doing these exams where you take them with me, these finals, probably in 2019. Nobody was doing it. I did 2 or 3 of them. I kind of got away from it because I was doing other things and teaching. So, but I thought I'd come back and try this. And what I can't believe, I haven't done the 65 yet. I haven't done the Series 65 once. I've done the 66, the SIE, the 7. I don't think I've done other ones. I probably did a 6 and a bunch of SIE exams, but I haven't done the 65 yet. So we're going to do it now. I'm going to see how far I get. It's 11 o'clock at night. I don't know if I'm going to get through the whole thing, but maybe do half. We'll see how it goes. Maybe I'll do part 1 and part 2. Who knows? Like, you know, when they do Hunger Games, the final is like 2 parts when it should be 1 movie. Who knows? But let's get into it. Let's get on it and enjoy.
Hey guys, don't forget to like, subscribe, and share this shit.
And don't forget, when you see the question pop up, press pause, try to do it yourself, write it down, hear how I answer it. Let's see if we get it right. Hopefully I get them right. Who knows? I've never seen the questions before. So remember, I'm actually reacting to them. So you're going to see how I react to them like you would. Hopefully I can help you get through this and we can learn together. Let's see what we do. We're going to start our exam. Let's see what happens. Okay. An investment advisor hires a new employee and her registration became effective July 14th. When is the IA required to renew the IR's registration? Okay, is it, I'm not going to read all the answers, but we can go through them. You're going to press pause, figure it out. So is it on the anniversary? It's in the fiscal year. Let's go with, since it's an IAR, let's go with the end of the calendar year because they all expire, whether you start on December 10th or, you know, July 10th, it doesn't matter. It's going to end at the end of the year. So I'm going to go with that as my answer. And look at that. Let's go on to the next one. Although the following characteristics of future contracts accept. Okay. So that's what's not true. So most of the contract's terms are set by the buyer and seller. The amount of the commodity being traded is standardized. That's sort of true. Because forwards are not standardized. Futures are. Remember, these are not securities. These are contracts about commodities. Prices are negotiated between the buyer and seller. I like that. And the buyer of the futures contract cannot be forced. So I'm going to say, I'm going to go for 1 and 4 here, because I think that the contract terms are set by the NFA, CFTC, and you can be forced. If you don't offset this thing by the time exercise comes, you might wake up with a yard full of hogs in your yard. Okay. A yard full of hogs in your heart. A yard full of hogs in your yard. Boom, there we go, 2 in a row. I should end now. We're on a good run. Which 2 types of risks are not associated with options and derivatives? Okay. So what's not? I love the knots. They do way more knots on the vendors than they don't. So tying a knot like a sailor. Okay. Reinvestment risk, opportunity risk, purchase of our risk, and market risk. So which is not associated? So I'm going to say for sure reinvestment risk. Okay. I'm actually going to say reinvestment risks are not going to be on there because reinvestment risk is for bonds and stuff that pays you monthly, or every semi-annual, yearly, whatever it is. So 1 for sure. So it's either 1 and 3, 1 and 4. So let's see. Do they have market risk? I think you can lose money on that. So I'm going to say, maybe I'm wrong. I'm going to say they don't have purchasing power or inflation risk. So I'm going to say 1 and 3. Barking up a tree, boom, 3 in a row. At the beginning of the year, an investor's portfolio was valued at 265. At the year end, it was worth 243. What is the approximate return on this? So how do we do returns? So bring out the handy dandy calculator. And all we're going to do is take your calculator and go, what's the difference? 265 minus 243, 143, 243, 265 minus 243. Oh, we probably could have just done the first 3 numbers. That gives you 22 grand. And I'm going to divide that by my original of 265. 22,000 divided by 265,000 gives me 80.83%. Boom. I was going to say 83%. I'm like, no, that doesn't work. So it's not negative. Oh, don't click the wrong one up here. It should be 8.3% because it is negative. Never mind. I'm an idiot. It did go down. See, that's why you double check and reread. You don't jump on it. So it did go down. So I actually lost 8.3%. Let's see if I'm right. A boom, we got 4 in a row. A boom. Okay. Which of the following statements regarding sports representatives is accurate? Read them all. In certain cases, so under 1092, they expanded the definition of investment advisors to include sports representatives. Okay. Um, so in certain cases, a sports and entertainment representative who provides advice is considered an advisor. Under 1047, they're making up numbers. Okay. Sports rep are considered investment only when they have power of attorney. And no, I have to think that, see, D, they're trying to trick you with the whole plate thing of separate fee. So I'm going to go with A as an apple. Okay. I'm going to press pause for a second. I have to see this text. Oh, you know what I'll do while I'm doing this? You guys read. There we go. I'll be right back. You won't even notice. Okay, I'm back. Did you miss me? Okay. What information is required in order to determine an investment's internal rate of return? Okay. So we needed the risk-free rate? I don't think so. Money supply in the overall economy, though the M1, M2, no. General market return, no. So we need the, so remember, to find the IRR is the rate of return, or present value equals future value in a way. So you need the cash flows. Boom. So it's got to be B, baby. It's got to be B. If I'm wrong, if I'm lying, I'm dying. Boom. There we go. A company based in Europe with offices located in Jersey would like to have its stock traded in the New York Stock Exchange. This would most likely be accomplished through issuance of, okay, this should be easy. It's it's ADRs, baby. ADRs are foreign security trading here. Bankers' acceptances are for foreign trade. They allow import exports to work. Eurodollar bonds are bonds issued by U.S. companies in another country, paid in US dollars, and Yankee bonds are foreign companies issuing bonds in here. Okay, so we're going to go with ADRs. Let's open right. And boom, we got a 7 in a row. I should stop now. I'm on a roll. Several years ago, a person received a gift of 300 shares of stock that were originally purchased at $10 a share. So 3 years ago, after the gift, the person then inherited 700 of the stock when it was at 20. This year, the person sold all of the shares for $40 a share. Okay, so first of all, gift, you get the original cost basis. So they bought them at 10. They sold them at 40. So they made 300. So they made 30 points. 300 times that. I'm guessing is 9. So I'll write it down because I'm doing it in my head, which you're not supposed to do. Bought the 300 at 10, and then condensed with a gift. You don't get a step above cost basis. Sold at 40. So they made 30 points times 300 should be 9 grand. We'll say 9 grand just for the hell of it. Okay, now the next one is if 700 shares and person died. Okay. So that's at $20 a share. And then they sold them at 40. So they sold 700 times 20, that is 14, right? So that should be, so we made $20. Remember, stepped up cost basis, $20. We sold them at 40. We made $20 times 700 shares. That should be 14,000. So 14,000 plus 9,000 usually is 23 grand. And it's all long term because even though they gift, there's usually you have to follow their cost, their time. It was held for at least 3 years. So that is long term, and death always makes the term. So the answer has to be $23,000 long-term gain. Boom. In an advertisement by an investment advisor, all the following information is permitted except a list of, okay. In an advertisement, public and private colleges that are asset management clients of the advisor, management directors of the firm, advisors' top 10 corporate pension fund clients, and performance of the advisor's managed account program relative. Okay. That's interesting. So B is okay. I think D is fine. So between A and C, I got to choose public and private clients, asset manager, clients of the advisor. I'm going to say C seems to be the biggest because it also has best returns. Let's see what they say. And let's see. Investment advisor advertising may refer to the testimonials as long as they're misleading. The returns of the institutional and corporate clients are often not representative of all clients. Okay. They don't address why. A is right, but I don't give a shit. Okay. Okay. The returns of institutional, I guess maybe the saying with permission. So you can't show the returns of specific clients because it's not representative. I think that's a tough question. What's a domestic settlement agreement? The power of attorney that gives the investment advisor discretionary authority over a client. A legal contract between two parties which outlines the obligations of one after the dissolution of a legal arrangement. a legal arrangement with authorized estate admin, blah, 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 a legal contract that permits several individuals to act as one entity. I don't think so. I think it's like domestic settlement when like people get married, divorce and shit like that. I gotta think it's that when somebody, it's a domestic settlement, like when we end, where does the money go? It's the only thing I can think of. And there we go. I was signed up for guess. Which is following the fees are easy. Read this. What's true about a buyer of a put? They have the right to buy, right to sell, obligations. Remember, buyers have rights, sellers have obligations. So this obviously has to be the right to sell 100 shares. Okay. A stock that is traded on the NYSE has a PE ratio of high PE ratio, low dividend, and a high level of retained earnings has to be. So remember, it's not going to be small cap or mid cap. They're not giving numbers. So it has to be a growth because growth has a high PE, low dividends. And a value has a low PE and high dividends. Boom. An investor has purchased a U.S. government bond for $1,000. The bond is now worth $850. Which of the following risks is a concern to this investor? Well, first of all, treasuries don't really have credit risk because think about this. If a treasury defaults, okay. If the treasury default, the least of your worries is because you're gonna be hiding in a basement with a gun out going, stay away from me, you zombies. Okay, so we don't have credit risk for sure. So anything with two and is it out? We don't have currency risk. It's our own country. So it has to be which two they have. It has to be 1 and 4. 1 and 4. They sound like Kamala Harris. Dropping the R's. Okay. Which two of the following statements are true regarding the buyers of options? Buyers have the right to buy. Buyer of calls have the right to buy. Buyers of calls have the right to sell. No. So obviously 1 is true. And 4 is true because you have the right to sell. So it's 1 and 4. Good. I'm going to make a stupid mistake because it's nighttime. What does leverage ratio mean? Leverage always means like debt, shit like that. So the amount of additional debt the issuer can assume, the long-term prospects of a business, the profitability, the amount of company. Okay, so it's got to be debt. Whenever you hear leverage, I mean, watch, I'm wrong, but it has to be fucking debt. Okay, anytime you see leverage, it's margin or debt, shit like that. Boom. That was a delay. I was a little worried on that. I thought it was going to slap me in the face. Slap me in the face and call me ugly. Which of the following aspects of an investment are not considered guaranteed? Okay. Which of the following aspects of an investment are not guaranteed according to the USA? Okay, so principal, dividends, and interest can be guaranteed by the issuer. Cap gains cannot. Boom. In a declining market, the type of order that would potentially contribute to the decline is, okay, so what happens here is that, so a limit order is anything with the word limit in it, so that makes it easy. A, B, and D are out, so it's C. But remember, so a sell stop, if the market drops, so you do a sell stop, you place a sell 100 shares at 40 stop. So the stock's above 40. If the stock drops to 40, right? Okay. And it triggers, it's going to become a market order, which means it's going to sell it on the next price no matter what, which could be push it down because whenever you place a market order, if it's big enough, it may push the price up or down. But market to buy is up, market down is down. And the Jets just got their ass kicked. So 25 seconds, you think we can score 13 points? So the answer is sell stop. Boom. So remember, a buy stop will push the market up, a sell stop will push the market down. The bigger ones, remember, slobs over below. Sell limits and buy stops are above, buy limits and sell stops are below. And remember, stops protect, limits don't. According to the USA, the administrator may require federal government advisors to, okay, do they register? No. Give notice or notice, okay, maybe. Register, no. Do nothing, no. So the answer is they might have to notice file if they have a place of business or more than 5 clients. Now remember, on this test, they may say 6 or more, or they may say more than 5. Either one works. It's the same thing. What securities are most likely used to create asset-backed securities? Okay, so this is a tough one. Okay. I'm probably going to get this wrong, but let's say asset-backed securities are not, when I think of asset-backed securities, I think of mortgage-backed securities. So I'm going to go qualified mortgages. Home equity loans. Oh, no. Okay. So I'm wrong on this. Yeah, I'm wrong. Okay. It's whenever I think asset-backed, I think mortgages. So I'm just going to leave it at that. I think this is, okay. I guess you're saying that. I guess I'm wrong. A broker-dealer must keep all the following records except broker-dealer, not an IA. Remember, broker-dealer. Original copies of incoming correspondence, yeah. Form AD for the investment advisors, we'll come back to that. Signed copies of the discretionary account, yeah. Copies of order tickets, yes. So we do, remember, I'm a broker-dealer. I don't have to keep the Form ADV for the IAs. Good. I'm really bothered. Right back. I'm really bothered. Okay, it bothered me. I looked it up. Asset-backed securities can be mortgages. Thank you. I do feel better. I don't feel like as much of an idiot, but I guess on this test, think equity loans, non-mortgages, but asset-backed securities absolutely can be part of the mortgages. Okay. I hate when I'm wrong. Yeah, it's just I hate when I'm wrong. Which of the following is true if the price of a discount bond falls? So okay. Ooh, I always screw this one up. The spread between the yield to maturity and yield to coupon will decrease and the yield to maturity will rise. The spread between the okay, so if the discount bond falls, that means everything's going to go up. Which will fall or rise. Okay, so it's got to either be A or C. I'm going to say that the distance gets bigger. I'm just totally guessing. Okay. When bond prices fall, the yield to maturity and the yield to call both go up. And I guess the call gets, it increases the difference between the yield to call and the yield to maturity does get bigger. Okay, that works for me. I guess because the yield to call becomes more and more attractive. So I guess it does go up. A broker dealer that's registered in state A is underwriting a follow-on offering for a local company whose stock is not on an exchange. As required by the broker dealer is making the final prospectus available. How long does a broker dealer require to deliver the prospectus to investors? Okay, so if it's a over-the-counter IPO, it's 90 days. If it's an over-the-counter additional offering, it's 40. Think biblical, Moses. There's another Noah, shit like that, 40 days. And if it's on an exchange IPO, it's 25. Since this is not on an exchange and it's a follow-on or a secondary, which means it's the second one or third one or fourth one or fifth one, not the original. Oh, I almost said 90. It's got to be 40 days. Very biblical. Boom. At the beginning of the year, the PE ratio of AB stock was 30. 3 months later, it fell to 15. There's bad news about the company's future earnings projections. Which of the following explains the lower PE ratio? The stock price decreased. Because I'll explain this. So it's got to be that. Now, this is why. If we have a PE ratio of 30, and let's say the stocks, the earnings are 1, that's 30 to 1. The only way for it to go to 15, and you will definitely see a question like this, the ratio. So in this case, our P ratio is 30 to 1, okay? Because it's 30 over. The only way for this to go to 15 is if the price drops to 15. This stays at 1. Here's why. Okay, understand something. If the price drops, it's not going to affect earnings. Literally, the prices go up and down all the time. Earnings is what the company does. But if the earnings go up, the price will go up because it's more attractive. So price will not affect earnings, okay? But earnings can affect price. So if you see the PE ratio drop, it's because the price went down, not because the earnings went up. Because if this went to $2 and this would not stay at 15 or 30, this would rise to like $60. Because if you have a company where the earnings double, people will buy the shit out of that stock and move it up. So when they ever say this about the earnings, the PE dropping is because the price dropped, not because earnings. It means the client to form a financial plan. Why should they ask for the age, occupation, and investment objectives? We want to make sure we're not doing it to make sure they're not laundering money. That's eventually we get all the other information. It's basically to make recommendations at work. We're doing suitability. Boom. If the NPV of an NPV of an investment is greater than 0, that means it's a good thing, right? That means it's probably the current market is less than the DCF or the present value. Has to be that. So the remember, the discounted cash flows ends up at present value. Okay. So if you do the DCF, you're going to find present value. If the actual market price is below that, because remember, present value is like the fair market value, the fair price. So if it's lower than that, getting a discount, that's a positive NPV. So it has to be current market value is less than the discounted cash flows. Drum roll, be wrong, don't be wrong. Boom. Which two of the following are true regarding the causes of inflation? I did a video on this. I think it's a good one, but I always have to remember. So demand pull means that the demand is pulling the prices up, okay? And that should be 2. Okay. We'll go. It's not interesting. Yeah, it's going to be 2 because demand pull offers when demand pull means the demand for something pulls the price of the goods up. So it's got to be 2 because demand means the demand for the product moves the prices up, and that's inflation. The cost push means the cost of the goods that you do. So let's say I'm a producer. Maybe I make, I don't know, cribs. And if the cost of wood goes up, or the cost of screws, or the cost of delivery goes up, that's cost push because the cost of my products is going to push this stuff up because I need to spend more money to get this done. Okay. So the answer should be 2 and 3. 2 and 3. The raw materials go up and that increases my prices, or that if it's demand pull, it's because people come in there and I raise my prices. Love it. Under the USA, for how long does an agent's registration remain in effect? I got this wrong on the test, I think, because I always screw it up. So it really lasts until you leave, but it does end when at the end of the year. So December 31st. You have to renew it not every 12 months, at the end of every year, December 31st. Boom. An individual currently has $100 to invest. She has calculated the future value of her investment will be 130 under favorable markets and 80 under unfavorable markets. Which of the following statements about the investor's future value is true? If market conditions are unfavorable, she will have a $20 loss. That makes sense. If it's bad, she's put in 100, she loses 80. It's kind of makes sense, right? The other ones don't work, okay? Because if the market conditions are good, she'll make 30. Everything else is there. The other shit you can't figure out. So it has to be that. So literally, that's the answer. Since if the present value is 100, and if the markets are bad, it's going to be 80, we lose $20. Don't overthink it. What's the best indicator of a successful mutual fund? They make a lot of money. No, it's tenure of the manager. Okay, tenure of the manager is how long the manager's been there. So if you have a fund with a very short manager, the manager hasn't been there very long, you don't really know what it's going to do. You want somebody who's there, that he or she knows the stuff, knows the story, knows what's going on, and has a kind of like a ingrained institutional knowledge of what to do. So under which of the following circumstances? I always hate when they do this because I always think they're going to trick me. On the exam, they're not as tricky. Under which of the following circumstances will an individual be required to register with the administrator as an investment advisor representative? Okay, solicits brokerage service will come back. B, she supervises the accounting department of a registered advisor. I don't like the accounting part. She holds herself out as an investment advisor rep. Now, I like that one, but I don't think that's going to be it because I think STC cap and don't think that's enough. She serves on a committee that makes investment decisions for an investment advisor's managed account. That sounds like right. They're making decisions. I'm going to go with D. I can easily see it being C, but I've been burnt by that way too many fucking times. Go. Okay. I guess the idea is that just holding yourself out as one doesn't make you one. You actually have to do the biz. An IAR discussing, read it. I'm going to read this shit. I'm going to read it. The client admits that the real estate market is near its bottom and is due to recover in the next 12 to 18 months. Since she has limited amount to invest, 50 grand, and wants an investment that is diversified and liquid, in the event she's wrong, the IAR may recommend now. You don't do partnerships. RELPs and general partnerships and real estate limited partnerships are not liquid. So throw an A and B in. Okay, now between C and D. Maybe C, but that's not really the thing we're going to talk about. So we're going to go with REITs. Whenever somebody wants to invest in REITs and wants to be diversified and liquid, D is the answer. Currency risk would be least of a concern for which of the following investors? $20-year-old retirement, parents for 13-year-old save for college. Yeah, I don't even know where they're going for this one. Okay, a couple seeking to investor annual contributions, saving to buy a house in 2 years. I'm torn on this one. 28-year-old saving for retirement, parents for 13-year-old saving for college. I'm going to go with, just because I have no fucking idea, I'm going to go with this because it's short term and you don't have a lot of risk when you're doing short term. I don't know. Why? My thing is, I think this is a fucked up question. I don't agree with this at all. Currency risk when they invest outside the country, not now. So I'm leaving this. I'm being okay that I got this wrong. Which of the following is true for the buyers of call options? Buy have a call, you have the right to buy 100 shares. That's it. Buyers have rights, sellers have obligations. To cut costs, a broker deal hires some college interns. The firm allows the interns to make calls to potential clients to market investment opportunities in stock, bonds, and mutual funds. This action would be acceptable if the interns are registered. That's the only answer. You can't fucking reach out to customers for this shit unless you're registered. Remember, FINRA and Nasaa don't really give a shit how you're hired. Just as long as you're registered, we're good. So if you're like a gig worker and you're registered, we're good. If you're a full-time employee, you're good. If you're an intern, as long as you're registered, that's all they care. You're associated with the firm. Lots of it. Good. Which of the following is an exempt transaction? Remember, read the thing. Exempt transaction under the Act of 33. It has to be an exempt transaction, not security. A is an exempt security. B is an exempt security. D is an exempt security. But Reg D, which is letter C, is an exempt transaction because it's exempt because you're doing a private placement. Boom. Which of the following investment advisors is subject to registration with the SEC? Which of the following advisors? Okay. Hedge fund. Okay, listen. An internet advisor, we'll come back to that. An advisor that has retail clients in fewer than 15 states. Nope. A hedge fund. Nope. Now, and if this is where I almost fell for this because I'm reading this going, wait a second. An advisor that expects to be eligible for SEC registration within 120 days. Oh, that sounds good. Of its second anniversary. No, within 120 days of filing the paperwork. That's why D is a tricky one. So it's got to be an internet advisor. It has to be. It's going to be in the works. Boom. An investment advisor provides advice exclusively through interactive website. They're going to be registered with the SEC. It's an internet advisor. Good. Good job, guys. Which of the following metrics would allow a financial professional to calculate the fair market value of a bond? EBITDA, no. Debt cap ratio, no. Internal rate of return, no. Remember, to find the fair market value is present value. DCF is how you find present value. I'll look like an idiot if I'm wrong, but I'm going to be cocky and say, boom. When would a variable annuity be most suitable for client? Never. Okay. When the client wants capital appreciation growth over a period. When the client wants a fixed rate of return, no. When the client wants an inflation adjusted return, ooh, that sounds good. When the client wants to receive predictable amount of income. Okay, that's not the answer. Now, the reason C is wrong is it does beat inflation, but doesn't adjust for inflation. Okay, the fact that it's invested in the market beats inflation, so it doesn't adjust for it. So we're going to go with A as an apple. Boom. All the following risks are considered types of unsystematic risk, except, okay. So unsystematic is business risk. Systematic is market risk. That makes it fucking easy. We can go with market. Remember, guys, if I'm going too fast, press pause first. Because once you see it, press pause because I'm going hard. Because it is now 11:23. I didn't take that long. A customer has recently provided an employee of a broker deal with material non-public information regarding the exchange traded company. What's the most appropriate action for the broker deal employee to take? Okay, use the information of benefit of all the customers. I like that one. Email the broker dealer's head of investment banking, let them know. No. Inform the desk that of the information. No. D, don't disclose it or use it or place transactions. A, B, and C, you go to jail. D, you're fine. Remember, having the information isn't the crime. Acting. It is most beneficial to the holder of a call if the price of underlying security is rising, as you're bullish. Okay, I'll be back again. My dog is calling. I'll be right back. Okay, I'm going to do 9 more. I'll get to 50, then I'll stop, and then I'll finish up another night. So you're not going to know because I'm going to come on here. I'll just have a different shirt on, maybe shave, who knows. Okay, let's come on. The amount of money an issuer receives, so I don't even know why I told you, but what the fuck, who cares? The amount of money an issuer receives in a stock offering in excess of par value is recorded on the balance sheet as, okay, so just remember, so that means that par value on a common stock is $1. So anything you sell it for over $1 is called paid in capital. which they don't have. So it's actually going to be capital, should be capital surplus. That's what it is to be watched. I'll be wrong. Capital gains is what you make when you buy it, right? Retained earnings is what you don't pay in dividends. Earned surplus, I don't think that's it. So it's got to be capital surplus or capital in excess of par. Drum roll, please. Good. I don't want to end on a bit. An investor is in the 20% marginal rate and has a yield of 10% on a portfolio. If the CPI is 5, what is the investment advisor's approximate after-tax fucking return? Okay, so here we go. So first of all, you make 10%, you pay 20% taxes on it. So you're bringing home 80. 10 times 80% is 8. And then inflation adjusted is where you subtract the CPI or inflation. So you're getting 8, you minus 5, take it away, that's 3%. So again, you make 10. It's kind of crappy, right? You make 10, you pay 20% in taxes, that leaves you 8. You subtract the CPI, it's 5, it leaves you 3. It's got to be the answer. Which two of the following choices are different between ETFs and ETNs? Okay. ETNs carry credit risk, which is tied to the issuer that backs the note. ETFs do not have issuer credit risk. I like that one a lot. So I like number 1. So I'm gonna stick with that. ETFs can be sold short and ETNs not. No, they both can be sold short in margin. Okay. ETFs returns are based on the performance of index. ETNs pay a fixed coupon rate. No. So the answer should be 1 and 4 because ETNs have a maturity date. ETNs have a maturity date. ETFs do not. Remember, so an ETN really is just a loan. You lend me $1,000, I'm going to pay it back in 30 years, and then whatever the index I'm tracking is up or down over the time, that's what you're going to get. So and again, I don't own the securities, so if I go out of business, you're screwed. So it's going to be 1 and 4. You know you hate when you do the Roman numerals and you're so sure of one and then they're not there. It's like crap. Also, you're going to get less. We've already had more Roman numerals than you will on the test. Taking the 63, you'll get a few, but on these two, no, they're trying to get away from that. What method of crediting? Oh, you know what I'll do? I'll do the 50 and then I'll just push it out there. And then, I don't know, I'll figure it out. You guys, you'll know because I do it, and you'll know if you see another hour after this, then you know I did the whole thing. If you don't, then you know I stopped at 50. What method of crediting an equity index annuity returns is based on the index value over a specified time? So pretty much all annuities are going to do point to point, which is like day to day. They compare yesterday to today, and that's the return, or December 10th to January 10th, or December 10th to December 10th, whatever it is. Point to point is like date to date, and they're comparing the return from one date to another. That's what. Love American style. American style is for options. Capped and binary are different things. Capped is like there's a cap on how much you can earn, which is not wrong. They do cap them. Binary is just 2 different things. Boom. A client buys a bond that pays $35 in interest every 6 months. The bond is selling in the market at 900. Now, if they say current yield, that's easy. You're going to do 35 times 2, which is 70, divided by 900. That would be current yield. They're not asking that. They're asking what's the coupon rate. This is easy. Remember, the coupon is based at 1,000. So if it pays $35 every 6 months, it means it pays $70 every year, which means it pays 7%. It's a 7% bond. Boom, 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 boom. I almost got it wrong. Which of the following is a characteristic of a money purchase plan? Just got to know this. Money purchase plan, the employer has to contribute money. They have to. That's the only thing you need to know. A money purchase plan, the employer has to contribute money. And Roth. If an options contract is exercised, which of the following statements is true? Again, buyer of the call must okay. So if I exercise an option, I get the right to buy. So I'm going to buy stock. But if I'm a put, I'm going to sell stock. So let's go through this. Buyer of a call must deliver the underlying stock. No, they get it. The buyer of a put will receive the underlying stock. I like that. Okay. Because they sell it, but maybe I don't like that. The seller of a put will be required to buy stock. The seller of a call will lose. So I always hate these ones. I flip them. The answer is C, because if I buy a call, I have the right to buy. So I'm going to deliver cash and get stock. If I'm a buyer of a put, I'm going to sell the stock and get the cash. A and B are out. If I'm a seller of a call, which is D, will I lose the premium? No, it's only if it's expired. So the answer is C. The seller of a put will have to buy. Because remember, buy a put is right to sell. That means sell a put has to buy. So the answer has to be C, as in Charlie. A broker-dealer has offices in X, Y, Z, G, and F. A broker-dealer has offices in state X and Y. One of its agents is registered in X, where the agent's primary office is located. The agent often travels to Y and uses the broker-dealer's office, ding, 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 there to meet with his clients. So since he's using an office or she's using an office, she has to register in state Y in addition to where she's already registered in X. Boom. An IA may charge a client an investment advisory fee for rendering investment advice while receiving compensation for effecting securities transactions related to such advice. Okay, is this okay? As long as you fucking disclose this shit out. Everyone, watch, I'll be wrong, but you can charge that and that as long as you disclose it. Now, if you do a wrap fee, you can't, because a wrap fee is supposed to include commission. But if you're charging an advice fee plus transactions, as long as it's disclosed, we are good to go. Okay, now you're not going to notice this, but I'm going to stop here. You might see timing change, a little different. I'll have shaved maybe. I may be wearing a different. Hopefully, I'm wearing a different shirt. That's gross. Might be doing it after my live. Who the hell knows? Oh, the debate's tomorrow, so I'm probably gonna have to do it after the live. I don't know what I'm gonna do. I'll get it done. I'll see you. Well, I'll see you in about a week, but to you, it'll feel like 30 seconds.
And we're back. Did you miss me? Probably didn't even notice I was gone. How does an administrator determine whether excessive trading has occurred in the customer's account? What do they look at? Financial situation, frequently of unsolicited trades, suitability of solicited, suitability of unsolicited. Okay, so churning can happen with unsolicited orders. That's the customer doing it on their own. So it probably has to be suitability of solicited trades. I've seen a lot of times on the test, they go, oh, what's not used, right? And it's usually gain or loss. Remember, so if they make money or lose money, does not matter. Does not matter. Making money or losing money is still churning, That's what they're doing here. So it's solicited trades. We don't care about if they have money or not. It could be a thing, but we don't care if they have money or not. Let's hope I'm right. And it's a boom. An investor who believes in the inherent efficiency of the markets would least likely adopt which of the following strategies? An investor who believes in the inherent inefficiency of the markets would be least likely to adopt which of the following strategies? Tactical, strategic, fundamental, or indexing. Okay. So remember, efficiency, they do not use technical trading. So let's see if we can figure this out. Tactical, strategic, which would be least likely to adopt which of the following strategies? Tactical, strategic, fundamental analysis. I'm torn between A and B because tactical is more like trying to beat the market. I'm going to go with that one. I could be wrong. It could be C. Let's find out. And boom. So fundamental, see, once I get the answer, I'm more confident. Tactical is trying to beat the market. So if you do that, you don't believe that it's efficient. Okay. Also, while you're reading this, because efficiency means that the price reflects where it should be. Okay. What type of analysis uses financial data that's specific to one issuer to make investment decisions? Okay, I think we're back to this. So this should be fundamental because discounted cash flow is about finding present value. Technical could be one stock, but it looks like trading patterns. And odd lot theory is all about the fact that retail are idiots and we do the opposite of them. I'm going to go with fundamental. Could be wrong. And we're right. Good. An investor has heard conflicting reports about the success of a company's latest products. The investor is unsure of the direction in which the stock price will move, but wants to take an option position. Which option strategy should they recommend? Should they think it's going to move? Like usually do this when Apple comes out with their phone. You don't know where it's going to go. So if I don't know the direction, I'm going to buy a straddle, which is buy a call and buy a put on the stock. Because buy a call, bullish only, sell a put, bullish only. Buy a call, sell a call. That would be for a short straddle when you think nothing's going to happen. So it should be a long straddle. Onward. An investment discount rate is 10% and has a positive NPV. Based on this information, which is the true? The rate of return is equal to 10, is less than 10, greater than 10, or it's always greater than discount. Okay, so we have a positive NPV, which means you're going to do better than expected. You're going to do better than the rate of return. So I got to think it's going to be investment rate of return is greater than 10 because it means it's worth investing in. It's got to be right. A boom. All the following statements are true of a 529, except withdrawals that are used for education are not subject to federal taxation. Well, that's true. There are no income limits. That's true. Contributions are unlimited. We'll come back to that. A married couple make a lump sum contribution of 180. That's true because you can do 90. You can preload 5 years. You and your wife or you and your husband can do 90 each. That'd be 180. So the answer is they're really high, like hundreds of thousands of dollars, but they're not unlimited. So that's not true. Good. Good job, guys. Way to go. For a single parent who has a low income and wants to protect her child in the event of her death, what's the best policy? Okay. Low income. So remember, poor people do term, right? Because term is cheaper, it's just pure insurance. There's no cash value or anything. So it's got to be the way. Terms has to be the answer. Boom. Thank you for telling me I'm muted. When investments in various mutual funds, an IA may recommend an emerging markets fund as a means of, okay. So kind of worked. When considering investments in various mutual funds, an IA may recommend emerging market funds as a mean of, diversifying. That's all we're trying to do. When you go outside the country, you're trying to diversify. I hope that's right. And boom. All of the following will impact the value of a bond except. All of the following will impact the value of a bond except. Rising interest rates, sure. Credit rating dropping, sure. Dividend payment, decrease in inflation. That would make it more attractive. So I got to think it's got to be the dividend. It has nothing to do with the bond because it's paid after anyway. Boom. Which of the following choices is a disadvantage of investing in a C Corp? Which of the following choices is a disadvantage? Shareholders claim the company's lost their own tax return. Shareholders pay tax on income that was already taxed. Shareholders have personal responsibility. No. Shareholders have no personal. That's true. That's an advantage. So the whole point of C Corps is they're double tax. So it's got to be B, as in boysenberry. According to NASA's model rules, which of the following is not required to be disclosed to a client when IA renews or extends a contract? The formula used to calculate the advisory fee. I think I always get these wrong. The length of the contract, any prepaid fees or penalties, and the investor's level of experience. I'm going to go with the level of experience because I don't think it's on the contract. That would be in the brochure. Boom. I was pretty confident. One of the main differences between futures and forwards is that forwards do not involve in commodities. No, they both do. Forwards may not be offset without permission. Okay. But futures are always used to speculate. That's not true. And an investor may not be short of future. That's not true either. So it has to be forward contracts. Futures, you can trade all you want. You can offset, get out of it. A forward, it's a contract between two people. It looks very much like a forward, but it's not liquid. And it can't be offset without permission, which offset means if you buy a future or you sell a future, undoing that thing. So if you buy a future, you sell out. If you sell a future, you buy in. That's it. So future forwards, it's one contract to one person, so you got to get permission from the other side. What's the NAV of an open-end management company that has 25 million outstanding and 75 million in assets and 20 million in liabilities? So I guess we have to do some real math here. Gosh, I hope I get it right. 75 million minus 20 million. I got to think, right? Leaves me 55 divided by 25 million. Gives me $2.20. It's got to be D, baby. Watch, I'll be wrong, but let's see if it's D. Oh, we got it right. All of the following are financial instruments. All of the following financial instruments are derivatives except leaps are options. Options are options. Futures are options. Sort of, they're not options, but they're derivatives. So it has to be a closed-end fund. Closed-end fund, open-end fund, ETFs are not derivatives. Boom. A trustee, I trust the trustee, is managing a trust that has beneficiaries ranging from 2 to 17. Under the UPIA, Uniform Prudent Investor Act, how should the assets of the trust be managed? You know you don't do it for the younger, the older, the neediest. You're going to do it for all of them. So you have to measure it for all of them. Which security is given to shareholders as part of an issuer's anti-dilution policy when it intends to raise capital. So the whole point of if you're a shareholder and they issue new shares to keep you from being diluted, right? Keep you from being diluted, what we're going to do is we're going to give you the ability to buy more shares. And that, my friends, is called a preemptive right. And there we are. Boom. A federal covered advisor must. I fucking hate Roman numerals. I really do. Federal covered advisor, register with the SEC. Got it. Register with one or more states. No. File from ADV. Yes, everyone has to do that. Become a member of NASA. Nobody. Okay. No. One entry, baby. One entry. Got to be that. Good. If a company's total assets remain the same, but the stockholders' equity decreases, which of the following statements is true? So let's do a little visual here. Let's say we have total assets of a million. And then we have, I don't know, total liabilities, let's say 200 grand. That means our net worth or our stockholders' equity is 800 grand. Well, that has to drop, okay? So if this is getting smaller, it's either this going up or this going down or the difference between them. So, but if they're saying the assets stay the same, then it means this has to go up to make it smaller. So if this goes to 3, this goes down to 7. So it's got to be liabilities increase. It's got to be the one. Got to be the one. Let me delete that stuff. Which of the following is the best explanation of the difference between progressive and regressive taxes? Okay, so progressive taxes are like income taxes and estate taxes, which the more you make, the more they take. So regressive taxes hurt poor people more, like sales taxes, tolls, stuff like that. That it's the same amount of money. It's like a value tax on a product. So if someone who has a lot of money isn't affected as much by it. So we're going to go. So it has to be D. Regressive taxes have poor people, lower income, pay more in taxes and higher because, like a sales tax, if I go out with Jim Cramer and he makes 20 million a year and I don't, and we both pay the sales tax, it hurts me more than him. So that's the answer. Okay. A family trust in state A was established 35 years ago. There are now 15 beneficiaries. According to the UPAA, the interests of which beneficiaries are paramount to determining the trust investment strategy. I got to think. You got to think it's B, all of them. It's like the same question. Hopefully I got it right. It's got to be all of them, right? Yeah, baby. Okay. What's the benefit of establishing a GP compared to an S corp? Okay. Limited liability for owner? That's not true. Efficient taxation? Yeah, pass through, that works. Business can own property? I think they both can. So I guess GPs don't require incorporation. And that's kind of true, that if you just can create a GP out of thin air and not worry about it. So I got to think that's the answer. Where an S corp, you have to file paperwork and file and all that shit. Where a GP, you go, hey, we're a partnership, and you're good to go. An investment advisor has an office next door to a broker-dealer. Okay, good buddies. The advisor directs all the client transactions to the broker-dealer. Of course he does. For execution and exchange, the broker-dealer rebates 10% of the commission received to the advisor. Is this okay? Sounds like a kickback to me, but it's actually allowed as long as it's a conflict, as long as it's disclosed in writing. As long as everyone knows that they're getting a rebate for sending business over there, you're good to go. I'll tell you wrong. Boom. So remember, conflicts of interest don't mean you can't do it. Just means you got to tell people about it. Severe conflicts, maybe you can't do. But if you have a conflict of interest, as long as you disclose it and sort of mitigate it, we're good to go. If a broker-dealer is registered in state X, which of the following actions will require the broker-dealer to become registered in state Y? An II, which it does business located in state Y? I don't think so. One of his clients resides in state Y? Mm-hmm. A broker-dealer no, that's an institution, and a bank, that's an institution. So sometimes IAs are not considered retail, but we're going to go with, they're not considered institutions, but we're going to go with that because we're going to go with B because it says one of its clients. Remember, BDs don't get the 5-person de minimis rule, even one retail client. You got to register, so I got to go with that. Boom. When describing the role of a SIPC, what can an agent tell a customer? It will cover all losses of principal? No. It covers losses incurred for the insolvency of a broker-dealer. I like that. It protects against fraud. No, that's more of a fidelity bond. And a guaranteed income, man, you can't do that shit either. So it's basically SIPC is for if your broker-dealer goes bust, they pay you up to $500,000, of which $250,000 can be cash. An Indy opened a brokerage account and placed trades on his own. The transaction subsequently generated a 20% return for the individual, but also very large commissions. Is the broker-dealer in violation of industry rules? Yes, yes, no, no. So if the customer is placing stuff on their own, it's not your fucking problem. Boom. It's not your problem. They want to do stuff. Okay. A company's PE ratio has historically been 30, but has recently dropped to 15. In this case, what has happened? Okay. PE is market price over earnings, right? So we go. Let's say I have a $60 market price and the earnings are 2. That's 30 to 1. 60 divided by 2 is 30. So if it dropped to 15, either this goes up, the earnings goes up, or the price goes down. It has to be one of them. Now, if the earnings go up, what do you think is going to happen to the price of the stock if the earnings go up? If the earnings doubled from 2 to 4, which would make it 15, this would skyrocket to like 100, 120. So it wouldn't drop. It would go higher. So the earnings will drive the price, but the price won't drive the earnings. So if the stock drops to 30 on its own, the earnings are still the earnings. So there's 15 to 1, 30 divided by 2. So the stock dropping won't affect the earnings, but the earnings going up or down will absolutely affect the price. So we're going to go with, that means the earnings has declined. No, that would be bigger. And the stock would drop. The price has risen. No, the price has fallen. There it is. Because the price moves nothing. Earnings moves the price. A 6% coupon bond is selling at a basis of 6.2. So that's a yield to maturity of 2. If interest rates in the market decline below 6%, the bond's basis will. This is tricky. I could easily fall for this because it's not asking about the price. It's asking the basis, which is yield to maturity. So if the rates drop, so does the yield. So it's got to go down. I almost pressed this button to say, oh, it raised right away. And then I'm like, wait a second. Wait, it's got to go down. Boom. According to NASA's model rule on the IAR continuing education, how many credit hours of continuing education must an IAR complete each year? Okay. I think it's 12 total. And yeah, look, it's not 0. Boom. Okay. It's not 10. I think it's 12. So it's either 6 and 6 or not 6 and 0. Has to be B as in boy. And the product stuff, if your FINRA CE can go towards your 6 hours of products, but not the ethics. So remember, not every state requires this. Okay. I think maybe 25 or 30 states do it. It'll pick up quicker now that most of them do. I think Florida and California picked up this IARCE thing. So then the rest will follow suit. Under USA, which of the following persons is required to register as an IA? A federal covered advisor? No, because that's under the Act of 40. Remember, always look for USA or NASA. They'll tell you what they're talking about most of the time. So if they say under the Act of 40, it's federal. If they say federal, obviously it's federal. If they say NASA or USA, they mean state. Okay. An accountant that provides investment advice that is incidental to a practice. A bank's trust department that provides fee-based investment advice. I think banks are exempt. Once I'll be wrong. The publisher of a financial periodical that responds to each subscriber with personalized investment advice. That has got to be the answer. Okay. Good. An equity index annuity is suitable for which of the following clients? A person who desires a high rate of return with little risk. A person who needs guaranteed return for life with no risk. A person who needs minimum guaranteed return with a potential for a greater return than CDs offer, and a client who needs tax-free income with limited risk. Okay, so D is out, it's not tax-free. Person who requires a guaranteed return for life, no. Okay, so equity index annuities, they have a floor and a ceiling, a sum of a ceiling, but they'll return better than a CD, but you can't lose money on it. So the equity index annuities have a floor of either 0 or 2%. Just got to be C as in Charlie. All the following investments are permitted in a 401k plan except shares of ETFs, mutual fund, employer stock, real estate. Okay. So 401k can take securities. They can't take non-securities. So if this said REIT, we'd be okay. That would be okay. But since it's just regular real estate, not sure it can hold that. There you go. Which of the following investments by a fiduciary most likely violate prudent investor standards? Spreading assets in a portfolio over 10 uncorrelated assets, that's like perfect. Investing 5% of a portfolio in foreign governments, that's fine because you're diversifying. Placing 100% of a portfolio in an IPO because you think it's going to go well, okay? And writing cover calls against 10% of the common stock in a portfolio, that's fine. Always cover calls are always good. It's super safe. and that's a way to generate income. So putting 100% in a portfolio is not good. That would not be diversification. Which non-qualified compensation plan can be offered to managers of a government agency? So you know that it can't be a 401k or a 401a because those are for corporations. So it's a 457 or a 403b. 403b is qualified, which means it has to be offered to everyone. 457 is for government, and it's non-qualified, so they can actually discriminate who they send it to. There you go, 457. All of the following are characteristics of a passive asset allocation strategy, except. So passive allocation has a lot of good things. Low costs. You're not going to have a lot of taxes and a lot of trades. Rebalancing, because they rebalance once a quarter just to keep it straight and keep it around where they want it. Altering a portfolio in anticipation of an economic event, they don't do that. That would be considered active. Trying to adjust for the market is considered active, and that would not be the way they do it. Which of the following statements is true regarding a client's occupation as it relates to her financial status and suitability of recommendations? It's important, relates solely to the amount of income it produces. It can influence the liquidity needs. I like that one. It is generally irrelevant. No. It is only relevant if the client works in the securities industry. No. So it's important because you have to know if they have a lot of money. Can they handle like non-liquid assets? Stuff like that. I got to think it's liquidity needs. Like knowing their income and their cash flow and their incomes and all that stuff helps to determine, do you need to leave part of their investments in liquid stuff in case shit hits the fan? It's got to be B. Good. If the economy has experienced rising inflation, that will generally lead to. So remember, common stock is great against inflation, but if you have rising inflation, that really hurts bonds. So I got to think it's got to hurt bonds by decreasing the bond prices because they're less attractive. Because remember, they pay a fixed income, so inflation really hurts them. Which of the following return calculations, my voice just cracked, which of the following return calculations removes the distortions caused by the deposit and withdrawal capital? Okay. So there's two types. So we're going to throw out C and D. So it's either time weighted or dollar weighted. Once you see withdrawal and deposit, it's time weighted or return. So dollar weighted includes people with deposits and withdrawals. So that's how time weighted ignores that. Time weighted is better from comparing managers. Dollar weighted is for like looking at your return because your money goes in and out. That's your choice. Here we go. I almost read the same thing. An investor purchases $50,000 worth of 6% bonds that was issued by a Brazilian company. If the bond is held to maturity, what will the investor receive at the maturity date? Okay, so we know that they're going to get half of it. So they're going to get 50 grand back of Brazilian reals, okay? And then they're going to get not the full 6%, they're going to get the 6%. They could be trying to trick me because a lot of foreign bonds pay once a year. We're going to assume that it pays semi-annual. So it means it's going to be paying 3% because that's half of it. So 3% of 50,000 should be 1,500. So I got to think it's going to be 51,500 Brazilian reals. Boom, reals, whatever you want to call it. One more. And then I got to take a break and then I'll come back and finish it. Hopefully I have this out by Friday. What Friday we're talking about? I have no, because you don't know when I'm doing this. Which of the following will the syndicator of a blind pool real estate investment trust include in the investment policy statement? I have such a blind spot for this shit. Estimated time of the real estate purchases, the estimated location, the disclosure. Remember, it's blind. The disclosure that the investment losses are guaranteed by SIPC. And they won't definitely have that not in there. And because they can't do that. And a statement which breaks down the contributions made by limited partners. I don't know. I'm going to say that since it's a blind pool, we don't know what they're going to do. So I would say the estimated location. I could be wrong. Okay. Oh, wait. Which of the following would be in there? Ah, that's interesting. I almost pressed the wrong one. I'm going to say D because A might be true, but I don't know. I'm going to say D just for the hell of it. I'm total guess. Okay. So I guess they have to give, they're basically going to tell what each person has to put in. Okay. Let me do one more. Drawbacks to the bottom up. Okay. Drawbacks to the bottom up generally would not include the idea that, okay, so bottom up means you're looking at the stock first and then going up, spreading out to the sector, the industry, then the economy. Top down means you start at the economy and narrow down to the industry, the sector, and then the stock. So I think bottom up. Huh. Okay, D is not true. I think C is, so it's either this one. So what is not true? It's weird. Okay. I'm just sort of guessing. I'm going to take B. I don't know what they're asking. I'd like to know what they're asking. Okay. How is lucky? Okay. I want to get one wrong on that one. One of the factors involved in evaluation of stocks is the management team, right? Bottom up looks at the stock and the management team, and they work their way up. So it does matter. Okay. So that's that. I have 50 more to go. I'm going to do them later. And I'll see you in about 30 seconds. Hey, I'm back. Did you miss me? Okay. There we go. It's only 1 o'clock in the morning. Okay. Let's get into it. An investment advisor, okay. An investment advisor is registered in many states, including the state in which its principal place of business is located. Okay. Which of the following statement is true concerning the IA's obligation to maintain a minimum financial requirement? Must satisfy the requirements of SECA. I don't know. Sounds like a Mexican and Mayan name. The IA must satisfy the requirements of the state. The IA must satisfy the requirements of only the state which its principal business is located. IA must satisfy the requirements of the state which has the largest number of clients. No, I'm going to go with home state rules, baby. Should be your own state. Boom, boom. I knew that was right. I love when I know that. An agent of a broker-dealer intends to sell shares of a security, but the transaction does not involve his firm. If he proceeds with the transaction, in which of the following situations will he not be accused of selling? I think the agent requests approval from both the state administrator and his firm. The agent notifies the firm and awaits approval. Okay. The agent awaits verbal approval. There's no such thing as verbal approval. The agent notifies the admin, but not the firm. I got to go with the awaits approval. Boom. Tell your firm, get approval, and they'll always say no, but you got to ask for it anyway. Boom. All the following items are considered earned income except. Oh, I always screw this up because it used to be alimony that was earned income. I think it's not anymore. Although, ask any wife. There's my wife. Yes, my wife. She's been married 30-something years with me. She earned every penny of that if she leaves me. Okay, let's go with earned income. What's up? You're wrong. Boom. All the following examples of digital assets except. Okay, what's not a digital asset? Crypto is. Stable coins. Non-fungible tokens, yes. NFTs are gone. I mean, they're such a joke. And blockchain. Blockchain is a system, not a token, an asset. Boom. Sometimes I just know I got them. Blue sky laws provide for state registration of broker dealers and agents, yes. State registration of investment advisors and IARs, yes. Federal, no. There's going to be 1 and 2. Let me double check to make sure it's not like some secret word that I missed. Nope, 1 and 2. Awesome. A new investment advisory firm registered with the administrator on June 1, just before its 1-year anniversary. Oh, the firm renews it. Why'd they wait so fucking late? Okay, it's supposed to be when? End of the year, baby. You should know this. It's not valid. The firm renewed effectively no. Yep. December 31st. It's not technically it lapsed on the 1st, not the 31st, but we're gonna go. That's the best answer. Okay. Because you have to, it's not annual, it's not every on your anniversary, it's December 31st. Securities are on the anniversary. Good. Sometimes I get cocky with these, and I'm going to make a stupid mistake at some point. Corporate shareholders must vote for with dividends. No, 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 no. Stock splits, mergers, and takeovers, and the board of directors. Okay, there we go. Remember, you should be pausing and reading this. So me reading it out loud is just a waste of time. Which of the following statements are true? The UGMA and UGMA and account to save for college tuition compared to 529. Growth is tax deferred. That is not true. That's a 529. Withdrawals are tax-free for qualified. That's a 529. Contributions are exempt from a gift tax limit. That's not a thing. And assets in the account are considered property of the minor. UGMA, it's in the minor's name, baby. It's their kids. It's their stuff. Boom. All of the following will be normally characteristics of a growth company, except, okay. So growth is high PE, high price to book, low dividends, high retained earnings. So let's see. High price earnings, that's a growth. High dividend payout, that's not a growth. C, high amount of research and development costs, who the fuck knows. D, wide trading range for, that's just volatile. Let's go with high dividend payout ratio is a value stock. Boom. A broker-dealer has been selling unregistered, non-exempt securities in non-exempt transactions. Not good. Without the permission of the state securities administrator, just a bad day. What action would the state administrator most take? Probably take his children. Require the broker-dealer offer letters of rescission. Okay. Bring an action in criminal court. This is not fucking criminal. And they can't do it anyway. Sue it in civil court. That is not their thing. There's no violation and nothing will happen. Well, that's not the answer. It's got to be broker-dealer, an offer of rescission. That means you're going to, what does that mean? That means you're going to give them the money back, plus a little bit of interest and a sincere apology. And they have about 30 days to say yes or no. By the way, that no was the Spanish version of no. Okay, here we go. A bond is convertible at $50 and is selling the market for $1,080. At what price per share must a common stock be trading at parity? Okay, so this is the thing. If they give you they give you a bond price and this and that. So they're asking what share must the stock be trading. So you're going to divide 1,000. So first you have to do par divided by the convertible price. 1,000 divided by 50 is 20. And then you're going to do 1,080 divided by 20. 1080 divided by 20 is $54. I should have probably figured that out because you probably didn't need to do the math. Because look, it's trading a little bit above par, and there's a convertible price. There's only one that's a little bit above par. Had to be that anyway, because they kind of have a relationship. I'm going to go with B. 101. 38 left. Well, 39 left, I guess. Let's see if I get it done tonight. It's only 1 a.m. An investor is long 1,000 bushels of wheat that he purchased for 50 cents a bushel. What's the investor's gain or loss if the price of wheat has dropped to 45 cents a bushel? Okay. So we'll say we know he lost money because he bought it at 50. So let's do this. So let's see if I can do this right. I always fuck up the numbers. So they bought it at 50, sold it at 45. We lost 5 cents times 1,000 bushels. Got to be $50. Yeah, I guess they're not doing it's not a future. So I guess it's a loss of $50 because it's 5 cents times 1,000. And if this was a future, it'd be usually you would do the loss times the number of bushels times the contracts. An investor advisor rep has been given a client's username. And I hate this fucking question. I disagree with this question so much, for the most part. Under access to brokerage account, the client wants the IR to have the ability to execute trades and withdraw cash. Such a fucking problem. Does this constitute discretion? No, since account held by a broker dealer. No, since a broker dealer must hold client's asset as qualified custodian. Yes. IRs always have custody and discretion of the client's cash. And yes, since the IR is able to withdraw funds and execute trades. Well, obviously that's true. So it must have discretion. But there'd be such fucking problems with this. Got to be that one. Because, yeah, they can move trades and they can do trades without telling you and withdraw cash to play the client's bills. Sure, somehow that'll go into his Ferrari. Under what circumstance may the administrator of X issue a cease and desist order on behalf of the administrator? That's not a fucking thing. X doesn't do anything for Y. If Y wants to fucking issue a cease and desist, they can do it their goddamn self. They're not going to do it on their own. Never. Fucking never. What's the difference between qualitative and quantitative? Well, qualitative is hard numbers. Quantitative is soft. Qualitative, let's go this way. So let's start at the bottom. Quantitative uses narratives. What? And qualitative does not. Okay, this fucking story. Quantitative is the only method to prove by print investor. No. And there's a qualitative is a metrics that are able to be counted or measured. No, that's more quantitative. So qualitative relies on descriptive judgments rather than objective measures. That has to be the answer. Quantitative is about metrics and numbers, and qualitative is at the soft stuff, like what people think of. That is the answer. Which of the following choices would meet the definition of an investment advisor under the Investment Advisors Act? So that's federal. I was going to say USA. A broker-dealer that holds itself out public as provider of research? No. I'll come back to that, but I'm going to say no. An accountant holds itself out of the public as a provider of financial planning services. Let's come back to that. A bank that holds itself to the public as a provider. I don't think a bank does it because it's trust services anyway. And a tech analyst holds themselves out as a public provider of foreign currency. Well, the good thing is D, that helps me because D is not it because it's not a security. So it's either A or B. And a broker-dealer is pretty much exempt as an advisor or excluded, whatever you want to call it. So I'm going to go with B. Drum roll, people. I'm afraid they're going to be like, don't you know they are, but we'll come back to that. Okay, we got it right. I hate when I hit it and I'm not sure. These are the ones I'm not sure because I'd be like, I know the rule and I would never get it wrong on the real exam, but these vendors sometimes go a little nuts. Which of the following is not included in a customer's adjusted gross income? Salaries, dividends received from stock, interest received from corporate bonds, interest received from muni bonds, because they're tax-free, they're deducted from your income, they better be right. Good. 108. Your client dies a miserable death, gets run over by a bus, leaves a sizable investment portfolio. Nice stuff. Within 2 weeks of his death, you guys can read the rest. They're asking, where's the value done? Okay. The value of the holdings declined substantially in the period between his death and their sale. For state tax purposes, the assets will be valued at the fucking death. It could be within, I think it's within 6 or 9 months, but you're going to predict the death because that's going to give you the highest cost basis. ABC has 10 million shares outstanding and they're currently selling for $50 a share. ABC is an example of what kind of company? Okay. I think they're doing, it's not cyclical defensive. I think they're trying to do the small cap, big cap. So I'm just gonna take a fucking guess, but I never know the numbers. I don't really care. 10 million times 50. What is that? 500 billion. I don't think it hits large cap. It might. I'm gonna get small cap because I think that's up to a billion. Good guess. Net cap 500 million to a billion, 300 million to 2 billion is small cap. That is so crazy that that's the numbers now, but it is what it is. A client contacts an investment advisor rep to discuss the advantages of incorporating. What are the disadvantages of C Corp? It's always like double taxation. Where is it? There it is. Double taxation. The only real bad thing about C Corp is double taxation. You can raise a shitload of money. You have limited liability. You have a two-tier structure. A lot of good things about it. It's the double taxation that gets you every fucking time. And it's expensive. What type of order may a customer use to protect profits? Oh, stops, protect, limits, don't. So where is it? Stop order. Boom. Stops, protect, limits, don't. I shouldn't have done that, but certain things I know. Which of the following is a measure of risk according to modern portfolio theory? Fuck. My mind, it's standard deviation because that's risk. That's the theory that shit will be outside. Okay, good. A 30-year-old single mom has income of 25 grand. Yeesh. They put money into an equity fund. How? For her 12-year-old son's college education. She wants to balance out the risk with a small bond investment and can hoping to avoid avoid accessing any of this money until her son turns 18. Which of the following is most appropriate for the mother? Okay, government bond fund. I know what the fuck it is. Muni fund, it's tax-free. She doesn't need that. High yield is a little too risky. I get it. She wants to balance out the risk. She doesn't want risky. So since she wants to balance out risk, she's going to go safer. And you're going to go with this. Whenever you hear college savings, it's always a zero coupon. Always. Oh, I got it wrong. I disagree with that. What are they saying? I think they're wrong on this. They don't need income. It's safety. I guess the government bond fund, fair. But I'm telling you right now, see, when I get it wrong, I get defensive. Okay. She doesn't want to access the money until it turns her into 18. She has a government bond fund. She doesn't have to reinvest it all the time. I think they're wrong on this, but it is what it is. An issuer is planning to sell federal covered security in state A. The administrator of state A, now I'll probably get like 300 wrong because I'm just fucking rattled. The administrator, that's why tell a lot of people don't do answers on because then you get one in a row, then you get two in a row, and then you're like pressing. And then next thing you know, you're like, fuck, I suck. I'm quitting. I'm going doing something else. An issuer is planning to sell a federal covered security in state A. The administrator of state A may ask the issuer to do all the following except. Yeah. Follow consent, service process. Everyone does that. Provide copies of the shit and pay a fee. No state does anything for goddamn free. Remember that. So basically, shit that the SEC doesn't require, you can ask for. The annual percentage return. Oh, what did I do? Okay, what's the median? I guess I can do this, right? Okay, what's the median? Probably write it down. Let me do it here. So what's the lowest number? -6 and -3. See if I do it right. 5, 6, 7, 8, 8, 11, 13. 14. Did I get them all? Okay. So what's in the middle? 1, 2, 3, 4. 1, 2, 3, 4. It's got to be 7, right? Median is in the middle. It's got to be 7. Because if I do, I think I did it right. 4 here, 4 here. It's the middle. It's got to be that. See, don't fucking play around. Just write the shit down. Don't even try to be cool about it. The major advantage of an S corp versus a C corp. Pass-through entity. Let's see. Is that an S corp provides its owner with limited liability? No, they're both limited liability. Has greater access to capital markets? I don't think so. Is it exempt from state corporate income taxes? I don't fucking think so. I think the corporation maybe, but the people aren't. May elect to be treated as a partnership. That's the truth. So if you have an S corp, you can either treat it as a corporation where it pays taxes and then the people do, or as a corporation or passes through. I'm going to go with pass through. I love it. Client has an annual income of exceeding 250. Good for her. He tells you that he wishes to retire in 18 years with a lump sum of $5 million. You tell him he can invest in zero coupon muni bonds that have a yield of 4%. If the client buys 5,000 bonds, now how much will he pay for each bond to achieve a yield of 4%? I always forget how I did this, right? So should be the rule of 72, I think. So 18 years, 250. Just hold on. I forgot what I did here. The client pays 5,000 bonds now. That's suppose it's 18 years. Okay, so I'm going to do 18 years would double. So he needs two. Oh, so he needs two. So the 8. So if I do 72 divided by 18, that gives me 4%. That means we're going to double our. If we earn 4%, we're going to double our money in 18 years, which is what the person's holding it for. So we need 2.5 million. So I assume we're going to do 5,000 bonds at what price? Let's see. 250 times 5,000. Oh, why don't I do it this way? 2.5 million. 2.5 million divided by 5,000. $500. Okay. So again, what I did was I understand we're going to earn 4%. We're going to get our money in 18 years. So I do 72 divided by 18. It works out to be the 4%. So that means I'm going to double my money once. So how to do that? Then I'm going to do if I double my money once, that means I'm going to have put down 2.5 million. If I do 2.5 million divided by 5,000, it works out to be 500. Which of the following is the best? I don't think they're going to do that anyway. Which of the following is best definition of a will? Power of attorney that admits an executor immediate disposal of assets. Okay, I don't mind that one. Power of attorney that empowers U.S. attorney. No, fuck that shit. Legal contract between two parties which outlines the obligation to one another. That's a domestic separation bill or something like that. And a legal contract which coordinates the distribution of assets and other legal matters after an individual dies. Okay, I'm torn between A and D. I'm going to go with A just for the hell of it, but I 100% know it could be D. Yep, I had a feeling. Okay. So it's a legal contract. It sets up where everything goes. Yep. Okay. Wills can also appoint guardians for children. That's why it's not. It says why it can't be considered a power of attorney because the person's fucking dead. Okay. I get them wrong once in a while. See, it's late. Preemptive rights provide which of the following benefits to their holders? What a preemptive right that lets you keep your percentage ownership so they don't get diluted. The ability to vote. No, that's a proxy. A guarantee that bonds can be purchased at a predetermined price. That's an embedded put option, right? Oh, no, that's like a call. That's a weird thing. That's nothing. Their proportion ownership would not be diluted. That's the answer, probably. And dividends will continue to be paid. No, it's proportionate ownership. So that's the whole point of a preemptive right, that they're not diluting your ass. Okay. What's the benefit to creating? Well, I hate these fucking good. Eliminates estate taxes? No fucking way. Does it reduce estate taxes? No. Oh, maybe it does. Eliminate state taxes and appoints an interstate enrichment. Interstate means you died without a will. So C is out. And it reduces estate taxes and speeds up the probate process. I don't know how it reduces estate taxes. It's got to be D. It's the only one that nothing. It's the only one that doesn't have something wrong. You don't avoid the probate. You still always have to get stamped. And it doesn't get rid of state taxes. At best, it reduces it. I guess because you're paying a lawyer less. I have no fucking idea. And we'll go with that. Okay. Okay, by distributing assets, wills can minimize the taxes. No way. Okay. They may not always be able to avoid it altogether. Fine. Okay. Another one. What are the advantages of LLC compared to an S? LLC is cheap, limited liability, good, lower corporate tax rates, simpler structure, management structure, and continuity of life. I'm going to go with simpler because literally they're all fucking members. Got to be that one. S corps have like the management and then the shareholders. This is just everyone just is a LLC. Everyone's a member. Which investment offers income tax relief? Apartment building, index fund, growth mutual fund, stock fund. The other three don't. Mutual funds are always taxable. I got to go with apartment building because you get write-offs. If it was wrong, I wouldn't be surprised. Real estate gives you tax breaks that other ones can't. An investor wants to know how much money he will have in 10 years if you invest 100 grand in a variable annuity today. Assuming an average return of 6%, this investor needs to calculate, well, invest if I put in 10 grand now at a certain rate, that sounds a lot like I'm trying to figure out the future value of money because I have the present value. I'll be wrong. But yeah, if I'm trying to find out what I would have in the future, I'm trying to get future value. Boom. Currency risk is defined as, I think I always get this wrong. Positive finish. Okay, so A, no. B, that a financial crisis, that's like political risk. Okay, C, that's interesting. But another emerging market, I don't think that matters. The possibility that changes in exchange rates will undermine the value of foreign investments for U.S. investors. It's got to be, right? It's got to be that one. Okay. Currency risk is the risk that the currency moves, foreign currency moves, and it's going to screw up your whatever you're buying or not. Okay. 15 left. I'm tired. A broker dealer is registered with the administrator under the USA. The broker dealer just had a sales meeting and told its agents to offer commission-free equity trade to any new customer opens an IRA. Management told the commission salespeople that all the trades would be immediately approved. But to follow up with documentation regarding each client's personal and financial information by the end of the week. I smell a rat. Which of the following statements is true? Okay. This business practice permitted? I don't think so. This practice is unethical? Maybe. I'm not going to get to them. B and C are possible. D is going to be out. Okay. Okay. It's unethical because trades have to be approved ahead of time. No, that's not true. So that's out. So it has to be B. The practice is unethical because the recommendations made by the agents are not based on required suitability. Right? They're saying, open up, put them in an IRA, pick what they want, even if they don't say they want that. And we'll approve it later. That's wrong. Wrong. You're wrong. An investment advisor's only client is a 3C fund that has 110 million in assets under management. Which of the following statements regarding the registration requirement of the IA is true? Private fund advisor, I think. Federal covered. No, it's not. It's not holding a mutual fund, so it's not federally covered. I'm going to go with no on that. I'm going to leave that out for now. That could be the investment advisor because it could be. I think it is an ERA, exempt reporting advisor. The investment advisor is regulated under the USA and must register with the state admin by filing parts 1 and 2 of the IIRD. If you have to register, that would be true. Investment advisor is not required to be registered. I don't think it is or anywhere because I think it is a exempt reporting advisor. But fraud is fraud. If there's fraud, they still come after you. But I think there's nothing there, which I'm wrong. I had the ER pet. I guess they have to do notice file. I learned something new every day. I thought they could just do it. Now you know. That's what I'm saying. I don't know the questions. I'm just figuring them out. Okay. The yield for a zero coupon bond is based on not dividends. It's not B. It's not fixed rate. It has to be purchase rate relates to. It has to be that because the other three don't make any fucking sense. In order for an individual to be eligible for an HSA, what do we have to have? We know this. I've done videos on this. You need a high deductible plan. There's no way around that. You need to. If you have a high deductible plan, then you can do an HSA. If you don't, then you can do it. And you work for a firm, you can do it in FSA. Boom. Under the USA, an investment advisor must deliver a disclosure doc to a client 5 days prior. No, within 3. No, within statement. Not fucking statement. at least 48 hours prior to signing the contract, or if given at the time, 5 days to rescind. I like that. So it's got to be the answer. So the rule is you have to give the brochure at or prior to signing the contract. Under state law, they go, that's fine. If you do that, you give them 5 days to back out. However, if you do it 48 hours ahead of time, they are locked in. It's got to be that one. Okay, final 10, maybe 11, right? Which of the following statements are true about marketing rules for investment advisors? Investor IARs can use IAR. That's not true. RIAs can use RIA. That's not true. So A and B are out. Registered investment advisors may disclose that they've been approved. No fucking way can you ever say approved. So that's out. Investment advisor reps may refer to them as investment advisor reps in their profiles. That's true. You can call it. You just can't use an initial because it looks like it's some sort of certification. So no way. Which of the following is an advantage of investing in real estate? Large capital expenditures. Less. Okay. What's an advantage? A, B, and C are not advantages. So I'm going to say D. Remember, whenever you invest in real estate, you get a bunch of tax deductions, shit like that. You still buy it. You're still doing it to become a billionaire, but you get deductions. Miguel is duly registered as an agent and an IAR. Miguel receives, just fucking around because I'm tired, it's 1:30. Mike 120, really. Michael receives fees for giving investment advice and a commission for each investment product that the client agrees to purchase as a result of the advice. Okay, so double dipping. It's a conflict and prohibited. We'll come back to that. It's not prohibited as long as it's disclosed. Okay, I like that. This practice is acceptable if they're affiliated. This practice is acceptable as long as the commissions are reasonable. Okay, I'm going to say that you can do this as long as it's not prohibited. As long as it's not prohibited, hold on. Scratch that, reverse it. It's not prohibited as long as they disclose the shit out of it. If it's C, I'd be surprised. Okay. A client of an investment advisor rep, it has an IRA. Client owns shares of the funds that invest in large U.S. equities. Muni bonds, small. Oh, I'm reading that totally wrong. A client of an investment advisor has an IRA. The client owns shares of funds that invest in large cap, munis, small caps, and U.S. treasuries. Which investment is likely to require immediate discussion with the client? Oh, yeah, no fucking munis in an IRA. No fucking munis in an IRA ever. That's just a goddamn rule. Which of the following statements is true regarding inverse ETFs? Inverse ETFs go opposite of the market. Inverse trade the same direction as index? No. Inverse ETFs trade in tandem with their benchmark. Inverse ETFs are exempt from both state and federal. Okay. So I don't like that they're derivative, but there's no other fucking choice. Tandem with their benchmark, unless they're saying they move the same opposite. I don't know what they're saying. In reality, I did not know they were derivatives. Good to know. You learn something new every day. But sometimes this is a good learning lesson. If you don't know something, but you can knock out the other three, the only thing left is the answer. Which of the following is a right that provided to owners of preferred stock? You have the right to use a fucking dividend. Literally, the only thing you can get from buying a preferred is income. So it's got to be A. But I'll read the other ones. Right to vote, no. I don't have a put option and no guaranteed dividend payment. They're likely going to pay, but there's no guarantee. So that's the answer. We have the right to receive a dividend if the board of directors approves it. If ABC is trading at 42 and the ABC April 40 call is trading at 450, what's your intrinsic value? Okay, so it's in the money by 2, right? Because anything above the strike price on a call is in the money. Anything below the put is in the money. So this is $2 of intrinsic or in the money. So it's either A or B. And then the premium is 450. So the difference is $2.50. Has to be A because these two have to equal that. So if the intrinsic is 2, the rest is 250. Boom, boom, boom. Let's go back to my room. Dun, 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 dun. We'll test all night. Okay. We'll read the book all night. An issuer, I'm getting a little punch drunk. An issuer of a closed-end fund decided to cover the sales fee for a follow-on offering shares of its fund. How would the broker-dealer classify this? Okay. I don't like any of this. No load? Never heard of the other fucking things. Yeah, I don't get it. Like open funds, closed-end funds are regulated. Yeah, we know that. Investment companies that don't charge a front or back end load, referred to as no load. I think that's a little too vague. And their no load closed-end funds are also considered no load. They don't have underwriting fees, commissions, or other offering expenses. Okay, fair, but I doubt they're going that way. Under the USA, an investment advisor is required to provide a balance sheet when it files Form ADV Part 2 in all the following situations except. So when do we not have to do a balance sheet? Investment advisor prepayment of fees? Yeah, that's true. Because it's more than 500. Custody, 100%. Inadvertently receive securities, but send them back after 2 days. I'm coming back to that one. And the investment advisor has the authority to execute transaction in an account in which a client has beneficial interest. I don't like that they're being a little vague and tricky on that. I'm going to go with C because you have to put it back within 48 hours, and that's 72 hours. Sorry about that. So that works, I think. Good. I was worried with those. There's definitely some where I hit and I'm not sure about. 80% of these I hit and I know, right? You can hear me talk. But then there's always like the 20% of them like, oof, I think I got it. But I'm not sure. Okay. Which still following statements regarding IA contracts are true? Okay. USA, they have to be in writing. So one is definitely okay. And four, I think I remember the IA Act of 40, them saying that they don't have to be in writing. I don't worry about these little minutia shit. Should be 1 and 4. USA has to be written under the Act of 40, not required. Last one. The phase of a business cycle that represents the bottom of the economy's decline is, you always want to make sure that you know like, it's the bottom of the peak or something like that. So it's going to be trough. Trough is the bottom. It's got to be right. Okay. Let's see how I did. Oh, I got a 96. We know which ones I got wrong, right? We'll go over them. Oh, here. All missed. Yeah. This one I disagree with because I know that mortgages can be, but I guess most likely, whatever. Current risk is least of concern. I still don't get it. I still disagree with it. I guess they're saying short term has it. This one, I already said I disagree with. I get why they say because you said safety, but I think zero coupon's still better because you have to have your investment risk. And the will, I fucked that one up. Most of the ones here I got wrong. I kind of knew I was going to get wrong because I knew that was a possibility. That's always sort of a good sign, I guess. Illegal contract that coordinates a distribution. Yeah. So a will just tells you where you put the money in. Oh, I thought I was done. Okay. Right. Is that the last one? Thank God. Okay. You're embarrassing. The IAs, if they're managing it, they are an ERA, but they might have to notice file in the state. Okay. Guys, we finished it. Not so bad. I got it. I mean, I don't know how long this is because I did it over a few days back and forth. But congrats for making it this far. I'm happy for you. Well, hopefully we can get this. We can do this again. Don't forget to check me out every Tuesday and Thursday night on YouTube at 8:30 p.m. I do a live Q&A. I've been doing it since like 2019. Doing it forever. Really long time. Can you tell I'm tired? I'm fucking exhausted. To 127, I'm hoping to be not bad. I did like 50 questions in like 30 minutes. Even dog tired. So I got to go to bed. I'll see you later. Have a good night.